Second quarter earnings season continues to rage on, guys, with this past week seeing yet another week of very big companies reporting, including some retail giants like Target, Walmart, and Home Depot. So, in today's episode, we're going to take a look at each of those, plus a couple of very popular tech stocks in Tencent and Applied Materials. I'll give you a quick update on each of their earnings reports, let you know how the market reacted to them, and as always, I'll even let you know if I consider any of these stocks to be a buy, specifically following these earnings reports from this past week. So it's going to be a ton of fun. I hope you're enjoying these weekly updates on earnings reports, but let's go ahead and just jump straight into it. All right, now as usual, we'll be going in chronological order here, and last week I really didn't see anything too exciting for Monday, but there was the home improvement retail giant Home Depot who reported last Tuesday, there was Target and Tencent who reported on Wednesday, and there was Walmart and Applied Materials who reported on Thursday. But starting first here with Home Depot, their stock was pretty much flat this past week, only slightly negative by 1%, and that's because earnings were also a bit of a mixed bag and really mediocre, I would say, at best. Yes, they did beat analysts' expectations on both sales and profits, but it was only by a small amount of less than 5% each, while more importantly, their year-over-year growth rates were pretty much all in the red, with sales falling 2% and net income falling almost 10%. I do still like Home Depot stock overall though, because even though I've never owned it, I just feel like it can easily fit in most people's portfolios if they really want it, as more of a, I would say, like a resilient kind of retail business that has actually done a great job of fighting off the retail apocalypse and adopting to e-commerce. I mean, many times you kind of have to go into their physical stores for large home improvement products that you either need help on or you want to customize, or maybe you just kind of want to see them in person. You know, things like lumber or appliances or plants. These are all things that you probably want to be shopping for in person in store, which, by the way, Home Depot has also always had really good return policies. I mean, I know I like to shop there just because I know I can return everything very easily. And I think that has built up a little bit of customer loyalty as well. All good things that bode well for Home Depot. But even when you look at online sales, most people wouldn't believe that they're actually tied with Target for the 5th place in America in terms of market share. So overall, I just think that management has adapted to the changing landscape really well, and they've even found some new growth opportunities in home installation services, which is making their business even stickier than it already is. Anyway, the result has been very stable financials over the years. I could see them struggling maybe in a recession or a housing market crash, but overall it has been pretty solid, even growing by a huge amount during the pandemic lockdowns, and that's also allowed them to pay a pretty solid growth-oriented dividend, which is too small for my taste at just a 2.5% yield, but the payout ratio is tiny, and the growth rate and growth history are both at double digits, so it'll likely get bigger over time. The only reason why I remain on the sidelines myself, though, is I would say because the stock just feels a bit too overpriced right now. I mean, we saw how the quarter had so much negative growth, and that's really because they're having a hard time comparing to the pandemic years where sales soared by 20% in 2020 and 14% in 2021, but have now plummeted to just 4% growth last year, and it's expected to actually turn negative this year before returning to just a very low single-digit growth rate in the year after. And that's probably okay if you just want like a slow-moving kind of reliable dividend stock, but for me, the yield is too low, the growth is too low, and even the stock price has already risen by more than $100 higher than pre-pandemic levels, which leaves the valuation around 40% more expensive than the sector on a PE ratio basis. So I just don't see where I'd get any kind of like really big gains from this one. I think it'd be good on maybe on a larger dip, but it's definitely a pass for me at these higher levels right now. Moving on to Wednesday, though, we had another retail giant report in Target, ticker symbol TGT, who, just like Home Depot, has also been growing their presence online. Like I said, they're tied for the 5th largest in America. However, their recent performance has been pretty bad coming off of the pandemic. For example, in the same quarter 1 year ago, Target had seen their profits get obliterated, crashing by 90% because of supply chain and inventory issues. What basically happened was that supply chains had been broken throughout the pandemic lockdowns, but once they were restored, Target ended up with an oversupply of product during a weak economy that they had to mark down on clearance in order to convince shoppers to take it off their hands, and thus the markdown on prices sent their profits crashing too. Fast forwarding to this year, though, in the second quarter, it made for an insanely easy comparison as their net income skyrocketed this time by over 350% as it largely recovered. However, Target has a new issue on their hands as some consumers are actually boycotting the brand because of certain topics that I don't really want to get too much into on this channel. But the result is that sales actually fell by almost 5%, marking the first sales decline in 6 years, which the CEO specifically pointed to the boycott as well as the weak macro economy and inflation as the primary reasons for the struggling business. So it's just kind of really overall just a bad environment for Target right now. Now, mind you, Target is typically a very strong company financially, doing over $100 billion in sales just last year alone. However, it seems that all these hurdles are leaving them with almost zero growth. In fact, sales are actually expected to decline this year and then still be almost flat next year as well. And as a result, the stock price was also about flat for the week and is currently down over half its value from the top. I'm not personally buying the stock myself though, because I just think that Amazon is a much better choice in retail and Target is just way too low growth for my investing preferences. However, I will say that if I was to be forced to choose between like Target and Home Depot, I would actually go with Target. And the main differentiator for that decision would be almost entirely based on the dividend, because it not only yields much more at about 3.4%, but it's also been grown for over 5 decades in a row, which is why you sometimes see more value-oriented dividend investors talking about buying this dividend king on the dip, where it's now almost 40% cheaper than the sector on a PEG ratio basis. That's pretty attractive, but for me, it is still a pass. One stock that I am actually heavily invested in though, and I remain very bullish on, is the Chinese tech giant Tencent, ticker symbol TCEHY, who is not only the absolute largest video game company in the world by revenue, even ahead of Sony with PlayStation, Microsoft with Xbox, or Nintendo with the Switch, but they're also a giant cloud computing provider with the third most market share in Asia, and sometimes they even make the top 10 global list as well. Plus, they're also one of the biggest players in artificial intelligence, where they use AI to power their cloud, gaming, and even social media and e-commerce platforms. Speaking of which, it's estimated that about 98% of all Chinese internet users use at least one Tencent-owned app. That's pretty crazy. They also own a stake in about 700 different companies around the world, which does make them a giant global conglomerate, and they have one of the biggest social media presences too at over 1 billion active users. So it's just an amazing company all around, and they too happened to report earnings this past week where they beat on estimates but missed on revenue, so a bit of a mixed bag. However, what I think is more important to look at is their year-over-year growth, because when you look at how much damage the Chinese economy has taken from the pandemic and you couple that with a regulatory crackdown on big tech, well, Tencent had actually gone from a very high growth, gigantic company to one that actually declined on both the top and bottom line last year. However, this most recent report showed that they are finally returning to growth again, with not only a double-digit rise in sales, but also a 40% rise in net income and 57% rise in operating income as well. Yet the stock continues to struggle, falling another 2% this week and still trading well below half its value from the top. That's mostly because the Chinese economy continues to struggle and investors just aren't really willing to take a chance on some of these Chinese tech stocks right now that also carry significant risk from regulations, as well as the political tensions between the US and China. But looking past that for a second, I just think that Tencent as a company has been on fire for years, and I would still rate it a buy as long as I accept the risks that it comes with. And I do treat it as more of like a speculative Chinese stock rather than a solid or dependable investment. But overall, it's definitely one of my favorite spec stocks for sure, and I really hope to own it for many years to come. I'm pretty bullish on this one long term. Finishing up with Thursday though, we also had Walmart and Applied Materials report earnings. And when looking at Walmart, I mean, you're talking about the second largest online retailer in America, but more importantly, when looking at just total retail revenue, Walmart is actually the number one market share leader in the entire world, even ahead of the almighty Amazon by more than double their retail sales. I mean, how crazy is that? And that gigantic size has also enabled them to reach a dividend king status, as they have now raised their dividend for a whopping 51 years in a row. All of that is extremely impressive. Unfortunately, though, that's where the good news mostly ends, at least for me, who is really more interested in bigger dividends, lower valuations, and more growth, as Walmart's yield is only less than 1.5%, while their sales are only growing by a low single digit percentage. Their EPS is only growing by around a mid single digit percentage. And while I can excuse the lower growth given their already massive size, the fact is that their stock price has already risen to an all-time high because of it, which leaves it trading significantly more expensive than the sector on really any metric that you want to look at. So I'm just not sure where I'm supposed to get my big gains from on a stock like this. I mean, I think it's great for someone that wants a very stable, reliable performer, and this most recent quarter was just another prime example of that, as they beat expectations once again while continuing to grow their sales and profits. Impressive for their size. But like I said, the stock is just a bit too high already, and I just think Amazon is the more exciting kind of innovative option. So I'd rather invest there long term instead of this one. But that's going to leave us with the last but not least stock here to cover, and that would be Applied Materials, who also reported that day. Ticker symbol AMAT, or I usually just refer to them as AMAT. But this one happens to be a very popular semiconductor parts supplier, where they basically develop, manufacture, and sell various fabrication equipment and also services to companies worldwide that engage in fabrication activity. And this latest quarter only proved yet again just how innovative and aggressive this world leader is at pushing the boundaries and just really not becoming complacent with their lead, as they not only introduced a new manufacturing process called HI chip integration that allows the manufacturer to combine different chips together into one kind of fully integrated chip system. It either puts chips together side by side or it stacks them on top of each other. These are processes known as like 2.5D or 3D chip construction. I know it all sounds a little confusing, but the point is that these chip systems used to depend on just one single chip running the entire computing circuit, whereas now they can be combined to become more powerful and efficient architectures. But on top of that, AMAT also introduced their new manufacturing platform called Vistara, which they claim is the most significant equipment platform advancement in a decade, as it not only is much more highly customizable, but it also carries thousands of sensors that feed into AI software to help the customer's development process improve over time and yield better results. It's also 30% smaller than previous platforms while consuming 30% less energy too, helping the factory reduce its carbon footprint and the heavy use of certain chemicals. So I could see a lot of companies wanting to upgrade to this platform. And although it's just really super impressive work for the future, but at the present time, the semiconductor industry is still suffering from major headwinds, one of which is a deteriorating macro environment post-pandemic, where global PC shipments have now been falling for 7 quarters in a row following the pepperoni lockdowns. And as such, AMAT is technically still in decline right now, with sales and profits falling by a few percent last quarter too, and are expected to continue posting negative growth rates throughout both this year and the next. They did, however, see explosive growth leading up to that, and they continue to beat the lower expectations from Wall Street really like every single quarter, which is why the stock actually climbed a little this week and is still somehow trading near an all-time high. But while the stock appears to be rich, I actually think that it's been suppressed a little, as it actually trades cheaper than the sector still by around 20% on a GAAP basis. I'm really torn on whether I'd consider this stock a buy right now. I think it's okay at these levels, and I certainly expect them to have much higher growth in the future thanks to their technological advancements and just how big I expect the demand for chips to become over the long term. But I'll probably be staying on the sidelines until I see another, really big dip in this stock price. I'm just not too big of a fan of buying a stock at the very top, especially when the environment is still pretty weak for their business. But like I said, I am a fan of them. I do like their long-term vision. So on a dip, I would actually consider picking it up. But anyway, I think that'll just about do it for this week's update. Let me know your thoughts down below on all the things we discussed. And make sure you subscribe because you won't want to miss next week's episode. We still have more big stocks reporting this upcoming week, including the extremely popular AI semiconductor stock NVIDIA, as well as a few other popular stocks in Medtronic, Zoom Communications, Snowflake, and a few others. So you won't want to miss that. But thanks again for stopping by, my friends. I hope you enjoyed the video, and I will catch you in the next one. Thanks for all the support. I'll see you next time. Take care. Bye-bye.